What's up, guys? Welcome back to another interview at the Future Blockchain Summit Dubai 2025. I'm Adel, the host. Today, we have Joseph, CEO and founder at Relm Insurance. Joseph, how are you doing today?
Adel, I'm doing great. Thanks for having me.
Thanks for being on the show. We are here to educate and learn about all the different businesses here at the summit. We'd love to know more about the genesis behind Relm Insurance.
Yeah, so ultimately at the end of the day, right, we set up Relm back in 2019 to fill a really critical gap in the digital asset and blockchain ecosystem. There was a lack of informed and dedicated insurance capacity to support and protect the companies that were building and innovating. And so we launched Relm really to bring that capacity to market and evolve our insurance products in a way that's both relevant and aligned with the companies pushing the boundaries of innovation and blockchain.
Got it. So this was back in 2019 where you saw a gap in the market.
Yeah.
That no one was filling this gap in terms of helping liabilities get solved. And you come in here and you provide that service.
Precisely.
And that's purely for blockchain companies.
Yes. Yeah, we insure across the digital asset and blockchain ecosystem from exchanges, payment and remittance platforms, custodians, asset managers, software developers, foundations, big and small, in more than 40 countries around the world.
Do you insure retailers or only like retail people, traders, or only B2B clients?
Yeah, I mean, we're primarily focused on
B2B.
Commercial counterparties.
B2B.
Yeah.
But let's say a transaction was made and a business made a trade and they lost their trade. You provide insurance to insure the full thing or a certain percentage of that?
So, well, it depends, right? Which is an annoying answer, but right, insurance products come in different forms and shapes and sizes. So, for example, one of the coverages that we've written a ton of in the digital asset space is a version of commercial theft, right, or commercial crime coverage. So, if you are, a company operating in any way that requires maintaining safe custody of other people's assets,
yes,
you have an exposure to loss arising from some bad actor stealing whatever assets under your custody. Right. And that can come in different, that can come in different forms. That can be theft of something physical, like an HSM, or it could be an exploit of some aspect of the way that you keep your private key safe.
Right.
And so we've developed a commercial crime policy that would run the full spectrum of digital asset custody exposures. So, in that example, if you're the trader, and let's say the value of that trade either is lost due to a counterparty, if we insure that counterparty for theft, let's say, there's a potential that maybe that would be covered.
So,
but it depends.
It still depends.
Still depends. Always.
It depends.
Yeah.
But end of the day, the way that you charge fees, the way that you monetize, is it a subscription model? Is that they pay you monthly, so that in the event that it happens, you then can reimburse them?
So, kind of. Right? I mean, the way that we operate as an insurance company is the way that a lot of traditional insurance companies operate, right?
Okay.
We charge what's called a premium.
Premium,
right?
One-time fee.
Which is a one-time fee.
One time. It could be millions.
Over the course of 12 months, right? These policy periods typically run 12 months. And the idea is that the premium you're paying as a company for, let's say, coverage we're offering you is supposed to be representative of the projected frequency and severity of loss. So let's say you bought $1 million of coverage for safe custody of people's digital assets and you paid $100,000 for it. Kind of the implication there is that you're subject to a full limit loss once every 10 years. So that's the very high level pricing logic in how insurance products are priced. Does that make sense?
Yeah, okay. So you charge premiums.
We charge premium.
Hey, it's a pretty nice model to have. It's a big rush of money in. But you're hoping that they don't, because by the time, if they do make a claim, right, you got to keep some of that money to give back.
Absolutely.
Then you're going to separate that money.
and we're always taking in premium a lot less than the limit of protection we're offering. So that's where underwriting comes into play, right? Underwriting is this idea of risk selection.
When with that lump sum of money, because I've been a landlord before, and I would take in a deposit, and I would put it in the markets. And when it's time to hand it back, I'd have to sell and put it back.
Right.
Do you do the same, or do you just keep it in a client money account and not touch it?
So insurance is one of the most regulated businesses globally, right? And one of the biggest points of regulatory scrutiny is the way that you invest the assets.
Okay, so you're allowed to invest that money.
Yes.
Oh, I bet you do.
But keep in mind, it's some of the most boring asset allocation and investment strategies globally. I mean, if you look at insurance companies as a whole, it's fixed income.
Yes.
Right. And you
Bonds.
get a few very capable companies like, let's say, Berkshire Hathaway that actually has a portfolio that's more allocated toward equities, but they're a special type of insurance company. 9 times out of 10, all of that risk is being taken on the liability side. It's not being taken on the asset side of the business.
Okay. So you're allowed to invest that in fixed income, well, as long as it's, not too ludicrous. Yeah, not too exotic.
Yeah, I mean, it's AAA from
AAA
liquidity and security standpoint.
Got it. Okay, no, it's good. It's good to get some insight on how insurance companies work, what they do with the money, what's behind the scenes.
You've heard that.
Because that's people's money. That's people's life savings in some cases.
Well, you've heard that expression. It's all about the float.
Yeah.
Right. What that means is the insurance company's ability to take premium dollars in the front door and put that money to work in a prudent, regulated, secure, and liquid manner, and generate a return on those dollars between the point at which you take them in and the point at which you pay them out. That's the way the insurance market has functioned for 300 years.
Maybe a ludicrous question, but who knows? Again, a liability is still a liability. It's an opportunity for insurance companies to come in. Do you foresee another companies, sprouting up, being an insurance in case you don't pay back? Well, or is that too complicated?
Listen, it takes a village, right? So while we certainly are operating our company in a way that gives us a 6-year track record of paying tens of millions of dollars of claims, the inevitable reality is that the need for capacity for companies operating in the digital asset space far outpaces the capacity of Relm as a standalone insurance company, right? So when you look at a marketplace like Lloyd's of London, or you look at the global reinsurance market, it's made up of hundreds or thousands of insurance companies that at the end of the day are taking slivers of a portfolio of risks, right? And ultimately, that's the way risk and protection for the digital asset system is going to evolve. You'll get more players, which means more capacity, more protection.
Got it. Amazing. We're going to wrap up. But before we do, for those watching and those interested to know more about you and Relm Insurance, where can they find you?
RelmInsurance.com. And as I mentioned, I'm on
LinkedIn.
Yeah.
Thanks so much for the interview. I appreciate your time.
Great seeing you. Thanks so much for having me.
All right, that is a wrap. Thanks so much for watching. Hope you found this insightful. We'll leave all the links in the description so you can check out Relm Insurance as well as Joseph's profile. Thank you again. I'm Adel, the host, and I will see you next time. Cheers.
Thanks, Adel.